Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. I just want to start off again by just saying thank you so much for joining me this morning. These are trying times for everyone. I hope everyone is staying safe, staying at home, doing your part in helping us stop the spread of this virus, and hopefully we can all get back to normal relatively soon. And for those of us that are lucky enough to still be gainfully employed through this, I just suggest that we try to be as compassionate as possible for those who may not have a job right now and may not have the prospect of a job to consider giving back to, whether it's your local food bank or contributing to helping medical doctors on the front lines getting medical supplies. Really some of the concerns that I have right now with us fighting this virus is, having doctors making sure that they have the right supplies to be able to deal with this. So let's go ahead and get started here today. A lot to cover. Before I do, just a quick disclaimer, what I'm just going to discuss here today is purely for educational purposes. It is not a recommendation to buy or sell any specific securities. Now, the big news that I want to go over is really the fact that the Fed has really stepped up in terms of providing market liquidity and to some degree provide a floor to the asset declines. Any of you that have been trading over the last few trading sessions, starting on Friday, things started to feel a little bit less panicky. We did sell off into the close on Friday. Yesterday, there certainly was a lot more stability in the markets, still sold off at the end of the day as well, but came back quite a bit in that last 5 minutes of trading and traded heavily higher overnight. Right now we're opening up a little bit higher here. Looks like we're opening up roughly about 4% higher, I believe. Earlier today it was trading around 234. It's pulled back a little bit around 232. This is pretty much the theme that we've seen in markets overnight, is that they move a little higher, but there certainly feels like there's a little bit more stability. And I think mostly this comes from the Fed's stepping up, right? And they've announced that they're effectively doing unlimited QE across the board, primary market facilities, secondary market facilities. I don't necessarily have enough time to go through each one of these, but effectively the Fed is trying to backstop companies that are going to need liquidity to stay solvent. They don't want mass bankruptcies across the board, so they're buying on the primary market as well as on the secondary market, similar to what we were doing in 2008. Term asset-backed securities, same thing also in 2008 to backstop the asset-backed market, commercial paper funding, so short-term funding for commercial companies, and as well as money market liquidity. So really stepping up across the board for corporates, for short-term, long-term money market funds, making sure that there's enough liquidity in the markets and making sure that there are buyers for these assets when everyone has kind of pulled out of these investment-grade products, even high-yield products, into treasuries. And we'll look at some of those names today as far as looking at where those are currently trading, because this operation that the Fed has stepped up on, we see some dislocations that we were seeing in the market kind of retreat and reconnect again, if you will. So those are some of the things I want to look at here today. But this is really the big news, and this is something that I think is the backstop to all of the bad news that we're currently seeing in the market, all the coronavirus news, and that sometimes can be very overwhelming. So this is kind of our bazooka, if you will, to fight the coronavirus. On top of the fiscal policy, right now we have a $1.6 trillion bill that's currently sitting with the Senate and Congress that they're trying to pass to create the fiscal side of the bazooka, if you will, because monetary policy can only go so far. That has not been passed yet. Both Europe and US have major bills on the table this week. If they do both pass, I suspect that we're going to see more stability in the markets. Now, we've been talking about a lot of bad news, and if you watch the news, you see new cases popping up everywhere, and you're seeing medical doctors say that they don't have enough supplies. So one of the things that I will say is that from the bond market, they have reacted fairly positively to at least the monetary policy side of things. Both the muni bond market, the investment grade market have rebounded fairly sharply off of this news, which is good. We'll take a look at both of these here today in terms of where they currently are trading, because again, this is really one of the places that we want to keep an eye out for in terms of stability in the markets. It usually comes from the fixed income markets first before it propagates into the equity markets. On another front, we've been tracking the number of new cases in Italy very sharply. For those of you that joined me on Friday, you might remember that the trend in China looks something like this, peaked around 21 days and then started to taper off. This is the trend that we're looking for. And we did see a few of what looked like promising results here and perhaps here, but they were very short-lived. So the fact that we've now had 2 straight days of declining new cases is certainly promising. That doesn't mean that we won't have another sharp increase, but the data so far shows that it is potentially going to start declining here in Italy, which is very, very good news. Again, we have to be cognizant of the fact that this data is new. So one of the things I want to show you is, the curve that we're really looking for is this curve that looks like this, where you have a rising number of cases and then slowly dropping off over time. And what we can do is we can use China to give us a sense for the number of total cases, which always looks something like an S curve, where you have an increasing number of cases, and most of the charts that you're looking at in Italy and in China look at like this, until at some point it kind of starts to curve down. And this is really why we're tracking this so closely, because that tells us when the curve starts to curve down. So looking at Italy, now what I have marked here is on March 8th and March 9th is really when Italy stepped up with the lockdowns. March 8th is when they had local lockdowns, and March 9th is when they had pretty much countrywide lockdowns. And since then, what we've seen is roughly 14 days from the start of that till they peaked. So that gives us somewhat of a template to give us an understanding as to how this will play out potentially here in the US. And I have some more data to show you on that front. But in the US, we really started locking down cities around the 19th, where as we see more and more cities locked down right now. I would say today was really the first day where I would say, across the country, we've seen fairly significant lockdowns. I would say a decent number of the population right now live in either cities or states that have that have suggested some level of lockdown, which is good. And what I have here on the right is our projections based on the rate of infection. And what we've done is we've basically taken the average rate of infection from the start of when we had 100 cases up till now. It averaged about 1.34% growth day over day. So we projected that 1.3% growth out into the future. And as you can see here, by April 3rd, if nothing is done, we should expect to see 1 million cases. By April roughly 11th, we should see 11 million cases. So far, we've been pretty dead on. So 32,000 was our projected for Sunday. Our projected for Monday was 43,000, and today we're at exactly 43,000. So right now we're still dead on, meaning we're still growing at a very stable pace, and that pace has not slowed down yet. So until we see these numbers start deviating from our projected numbers, that's when we're going to know that the lockdowns are working. But again, using Italy as a template, we see that the peak happened roughly 14 days from the start of that lockdown. So, we can start maybe on the 21st or 22nd, project out roughly 14 days, and that puts us somewhere around April 4th, which puts us around 1.4 million cases. So those are the numbers that I'm currently projecting at the moment. The one, some good news on this front is looking at some of the high frequency data. This is data out of Bank of America's institutional research. And what we have here is just a chart of, how concerned are we? And one of my concerns was that the number of people that said that they were not concerned was still pretty high in just a few days ago. It was still in the 30-40% of people saying they're not concerned. That number has decreased down to the I would say low teens, if you will. And the number of people who are saying they are very concerned are sharply increasing, which is good, meaning we're taking this seriously. The number of people who have lost their jobs in the last few days has increased to about 45%, which obviously is not a good sign, but that means that companies are also locking down, which is good from the perspective of this might limit the length of the economic impact. It does have a drastic economic impact, but it might reduce the length, which is really, I think, more important for us than anything else. The number of schools that have closed have pretty much been almost 100% of the schools have closed. Again, good, not good from an economics perspective, but good from a containment of the coronavirus. Some more data, restaurant data, as you can see, is pretty much declined almost 100%. So pretty much almost no restaurants are open at this point. That is also a good sign for the containment. Movies have basically gone to zero. Airport travel has decreased by a significant amount, more than 80%. Subway ridership in San Francisco has decreased pretty much 90%. So we're seeing this type of data across the board. This is high frequency data that we have, basically daily data that helps us gauge how seriously are Americans taking this, how much are we hunkering down, because that is what really, if we can really shut things down like they do in China and Italy, then we have some data to show that we can contain this within 2 to 3 weeks and start normalizing. And the sooner we can normalize, the better this is for our economy. So right now, our projected decline here is roughly about a 12% decline in economic activity in Q2. We're expecting to have a 0.5% growth in Q1. Q2 is declining 12%. And what we're really hoping for is a move back higher into positive territory by Q3. Again, this is heavily dependent on whether or not this country can hunker down, limit this economic decline just a few weeks, and start normalizing by Q3. If that is the case, and so far the data that I'm looking at is better than what I was seeing on last week on Friday or Thursday. So I would say that this is a net positive for me to see, projections of 3 to 4% growth in Q3 and Q4, meaning we can get back on our feet. We technically are entering a recession because a 12% decline in Q2, even if we have 3 to 4% growth in Q3 and Q4, is certainly still going to be negative for 2020. But that still means that we're getting back on our feet in Q2 and Q3 and Q4, which again is a net positive from my perspective. So, that's the data that we're currently looking at. As I said on Friday, and I'll say again today, this data is very high frequency data. It changes all the time. Markets still remain very volatile. Overnight we were trading around 234 when I woke up this morning, 235. It's pulled back to about 230 now. So we've already gone down quite a few points in pre-market trading. So the levels still are 235 is a major support level that we've broken. That is still concerning to me, the fact that we've broken below 235. As long as we stay below 235, I still believe that we're going to head towards around 213, and 213 is a support level, which goes back to, if we look on the weekly chart, 213 is a level that we were trading at back here in October of 16. And then 200 level is a big psychological level that we traded back here. And so we're going back to 2016 levels right now. We're referencing 2016 levels as support, 200 and 213 on the S&P. The VIX has pulled back substantially. We've pulled back from a high of 85 down to the 55 level. I expect that today we're opening up going to be a little lower as well. So volatility is starting to come down. Some of the names that I wanted to keep an eye out for is gold. Gold is opening up at 151. This was a major dislocation in the markets that we saw as a result of liquidity issues, because normally we would expect that as the markets were selling off, that gold would continue to take off. But instead, we saw gold sell off heavily. This was not expected. And this really spoke to the liquidity issues, meaning traders had margin calls. They had to satisfy those margin calls. What were they doing? They were selling their profitable positions in gold, or positions that weren't down 30, 40%. So gold got sold off, even though there was demand for this type of safe haven. And now we're starting to see gold finally snap back higher. It's about to open around 151 or so. So this dislocation is starting to disconnect or reconnect, whatever the term is. But, this tells us that the liquidity issues in the market are starting to ease a little. Again, this goes back to the Fed discussion that we were having earlier. Looking at some other names like the Muni Markets. The Muni Markets also looks like it's opening up around 1810, up about 11%. So the Muni Markets are doing better. Oh, sorry, LQD. This is a popular bond market, opening up a little higher here, around 115 or so. So this is the investment grade corporate bond ETF. Also easing a little, well off its lows here from the March 19th lows. So everything is easing a little bit right now. So I don't think we can breathe a sign of relief just yet. Again, the S&P is still below a major support level around 235. If we can break back above that 235, that would certainly be a good positioning for potentially getting out of some shorts and start thinking about some longs. And just on that front, for those of you that are thinking about bottom picking or thinking about, whether or not this is the time to start establishing some long positions, how do you go about thinking what stocks should I position in right now? Some of the names that we're really focusing on is more on the tech side. We're thinking about names that are likely going to recover quickly in a market like this. So tech is about to open up around 73.35 here, just above, a little bit above that 20-period moving average on a 1-hour chart. Right now we're looking at 1-hour charts because things are moving so quickly. Normally we look at weekly and daily. Now we're looking at daily and 1-hour charts just because of how quickly things are moving. XLK is certainly one place that we're going to seek. Another one is just anything that pays a decent dividend. So if we look at something like a Schwab Strategic Dividend Equity, this is something that pays about a 4.2% dividend yield. Focusing on yield right now makes a lot of sense, especially as things start to stabilize. This pays, I think, again, of about a 4.2% dividend yield. These are some of the names that we're paying attention to right now, as things start to stabilize. Another good piece of good news is liquidity. Last week on last Friday, we said liquidity really got, liquidity kind of evaporated from the markets. We saw about only 10 to 12 names that what we normally would consider liquid. Normally we had about 120 names on that list. Last week on Friday when I did the session, we had only about 13 names in there. The good news is that list is now expanded to roughly 27 names. They're all the heavy hitters that you would normally expect, like Tesla, Twitter, NVIDIA, the SPYs, Qs, Amazon, Facebook, Microsoft, GLD, SLV. These types of names, TLT, Bank of America, Apple, are now, becoming a little bit more liquid. We still see the total number of names that we would trade normally, which would span, in the 200 to 300 names. Right now, still only about 55 names. So still not by anywhere means close to normal, but certainly the liquidity concerns are starting to ease. Again, this doesn't mean that things cannot get worse. It's just we're just starting to see the signs of slowly this market stabilize, finding some liquidity, and being able to trade, perhaps some single stocks as well. So implied correlations have also, I believe, come down a little. Let's take a look. Implied correlation is currently trading around 62. So when we reference this, we hit that 98 mark. That was really when it made no sense to trade individual stocks. You should just trade ETFs. This metric, when we looked at it on Friday, hit about, was still in the 70s range. It's pulled back to 62. Let's see if today, when we open, if this pulls down a little even further, if this pulls down below 50%, that's when I would say we can start taking a look at some individual stocks as opposed to trading some of these ETFs. Right now, I think it's still better to trade broad-based thematic views, if you will, through an ETF rather than trying to pick individual stocks. But I do expect that if this trend continues, that we would get back to some semblance of normal in the next week or two, if you will. Again, this is heavily dependent on the trends of the coronavirus. And keep in mind that right now we're still focusing our data on Italy and the US. Spain is coming up as a third country right now in terms of largest number of cases, but we still have the rest of the world to think about. There are plenty of countries that, are way behind us in terms of establishing lockdowns, having access to the medical facilities to battle this and contain this. That's going to be a long battle. As far as whether travel will come back globally is yet to be seen. So there's a lot of uncertainty that's still in front of us, but we are starting to potentially see some green shoots at the very moment. So that's a market update that we're currently seeing right now. I have just a couple of minutes to answer some questions if anyone has any questions into the chat window. But I hope that this was useful again in helping you better understand what data we're looking at, what research we're looking at, and help cut through some of the noise right now, because I know there's a lot of data that you can look at, a lot of news that you can look at, and sometimes it's a little confusing. So if you have any questions, please type them into the chat window. I have about a little less than 5 minutes to answer any questions that people may have. Johnny, Raphael, thank you so much. I really appreciate it. Any questions before I sign off here? Manu, thank you. Max is asking, what are your thoughts on non-tech stocks like brick and mortar shops? I think it's a little early. I usually like to use McDonald's as kind of a proxy for all of that. So we see some stability here in the 136 area. But, I can't. So, I think what's different about McDonald's is that McDonald's is more global. And I think, again, global, we're still going to have more problems. So right now we're focusing on the high frequency data in the few developed markets that we're really tracking right now. Chipotle, which is predominantly only US based, may come back online a little quicker than McDonald's. So as you can see, Chipotle is performing a little better than McDonald's here, up 7% pre-market, back up to 629. So again, these are the green shoots that we're currently seeing. This certainly looks a bit like a bit of an inverted head and shoulders here that's starting to form here. So, could you target back into the 700s, even maybe the 800s here in Chipotle? I do think that you have a lot of traders that are trapped up here, traders who had bought here, maybe even here, that are trapped in these longs. So as soon as these stocks get back to these levels, what you're going to see is a lot of selling, because people who are in losing positions that want to get out at break even. So I think you're going to see a lot of selling pressure as these stocks rally. And I think you're going to see these, likely what you're going to see are stocks that rally are going to get hit, maybe rally a little bit, get hit some more. You're going to see more of a grind rather than just a quick move higher. That's my thought on, and that's not exclusive to Chipotle. That's pretty much on all stocks. Oil stocks, I still don't think oil's out of the blue here. Crude is still trading at $24, which is below pretty much every country's break-even price here. So I don't think energy stocks is a place that I would take a look at. Healthcare stocks, XLV has not been doing particularly well. XLV continues to move lower, but it is one of the strongest sectors. So, keep paying pay attention to that. But, right now it's not my favorite sector. XLF is certainly one place that you might want to take a look at, but I will say I wouldn't necessarily buy XLF across the group. I'd look at more individual names in that. I would wait a few days, wait for liquidity to come back a little bit more. Right now, really only Bank of America and JPM are the two banking stocks that I would touch from a liquidity perspective. I would wait to see if there's a few more ETFs a little bit more liquidity come back into the markets, and then I might play some individual names that are maybe better positioned for recovery. So again, a little still too early. I think right now my focus is still more on the broader thematic views. Tech, dividend, focusing on yield is certainly where I want to pay attention to. Do I think the market has bottomed yet? Really hard to say. But again, the data right now is certainly a little promising, but I would say there's too many unknowns right now to call a bottom right now. So with that, again, I just want to thank everyone for taking the time out here this afternoon. We are back here later this week to give you another update. We're trying to do this as frequently as possible so that you guys are kept abreast of kind of what's currently going on. But it's really important that we all, again, do our part in staying at home, washing our hands, stopping the spread of this virus so that we can try to get back to normal sooner than later. So thank you so much. I hope you guys have a great trading day, and I'll see you guys in the next session.